Well, good morning, everyone. This is Michael Douville coming to you from beautiful Phoenix, Arizona. It's September 1st, 2020. This is another Creating Wealth webinar. Tava and I are in the super plush studios of West USA, and this is one of my favorite episodes today. We're going to be talking about my favorite asset class, residential rentals. Next week, we're going to be talking about strategic real estate and how that's going to fit into your portfolio. But before we get started, I do want to thank West USA for allowing me to have this platform. I know they're dedicated to their agents to make sure that their agents not only have a great business, but they develop some wealth along their life, along their career. They can build a really good retirement for themselves. And keep in mind, retiring is a financial decision, not an age. So you can retire whenever you'd like. You can semi-retire. You can stay in this business for as long as you want. Now, one of the reasons I'm giving back is because most of my friends are broke. Most of my friends, when they get to be my age, they start to realize that I don't have any reserves. I haven't thought about my retirement. And they're starting to struggle. And they're getting older. And they're still working. Now, here's the crux of this. I've been in this business for 40 years, so most of my friends are real estate agents. We're no different than the regular public. We forget about the fact that eventually we're going to want to quit working and go do some fun things, take our honey, and let's go climb the Eiffel Tower or dive the Barrier Reef. We forget these things, so we've got an opportunity coming right at us that we can go ahead and make those changes. And today we're going to talk about some of those things. We're going to do a case study today as to how these investments age and how they work for you so beautifully. So let me just, we've got a different formats. I'd like you to make sure that you like these formats. Again, we're talking next week. We've got strategic real estate. Also, Friday, we're going to have a recorded session with Joe Needham coming in. And Joe, of course, is a long-term investor. We're going to talk about how investments in his life has changed his life and how his world has gotten much better because we have a strategy for this. So a couple things coming your way. So before we get going, I want to here's today's topics that we're going to talk about. Now, we do these topics a couple weeks in advance. We get these episodes done so that you can get these graphics. So here's 6 topics we're going to talk about today. I want to add another topic to this while we're here. And last Thursday to be exact, we had a seminal change in our investment world. Now, a lot of this went unnoticed. A lot of people didn't realize this. It didn't get much press coverage. But last Thursday, the Federal Reserve came out and said they are going to allow inflation to run hot. They've come out and said they're going to allow inflation to exceed their 2% targets. They want to include inflation and start getting inflation into our system. And one of the reasons is the Federal Reserve has really painted itself into a box. They can't raise interest rates because there's so much debt. If they start raising interest rates, well, the interest will take up all of the available revenue just to service the debt. So this debt is pervasive across the entire globe. Here in the United States, of course, the government just unleashed $6.3 trillion of new debt in the last, in 60 or 90 days. Municipalities, cities, towns, states, sovereigns are up to their eyeballs in debt. And one of the ways that debt is relieved is by inflating it away. And the Federal Reserve Thursday said that they're going to try and ignite inflation. So you need to pay attention to that. As soon as those words were uttered, you should start thinking, I need real assets. And of course, a lot of people are going to start thinking commodities. They're going to start thinking precious metals. But here's the problem with gold. I mean, I love gold. I think gold is a great inflation hedge. You can't take it to Costco and fill up your car. What are you going to do with it? It's a great store of wealth, but it's not usable. So you need to start thinking that residential rentals are probably one of the greatest asset classes that you can possibly get for inflation, and they cash flow. They'll always get that cash flow that's going to go to market. So as it becomes an inflationary environment, your rent is going to increase along with the inflation. So keep in mind that's another prime example as to why you want to put residential rentals into your portfolio. This is just if no matter who you are, you need to start thinking of residential rentals or some kind of a cash flow. So let's move on. So what's the best cash flow for cash? What's the best asset for cash flow and capital gains? Well, this is an easy one. This is my favorite asset class in the whole world. This is just the best one there is. It's residential rentals. And what asset class has the least volatility? Well, I'm going to tell you, we know what that is too. That's residential rentals again. Now, last week we talked about divergences that are in the marketplace. You can see the fact that the stock market is reacting to all this liquidity that's been put into the economy, and of course, it's gone up substantially. Now, with that liquidity, you have traders that are trading within that liquidity, and it causes volatility. And we saw what happened with that asset class in March. That asset class, talk about volatility, collapsed. It just got crushed. And of course, lots and lots of sleepless nights going over that. People took losses. They probably sold. They had a terrible, terrible time. It's come back. But again, we have a divergence. So does that divergence mean that we're going to have more volatility where these prices keep going up and down? You don't have that with real estate. Real estate is a long-term investment. One of the problems with stocks and bonds, of course, is it's instantaneously liquid. People have a tendency of buying and selling and just pushing that button and it's over with. Real estate is a long-term asset. We have leases in place. We have mortgages that we're dealing with. We have time frames. And it becomes very, very conservative. And of course, when you have a conservative investment, it's something that's kind of like stable in your portfolio. It's a lifeboat for you and your family when things are in turmoil because it throws off a cash flow. And what is the theme that we're talking about? Accumulate appreciating assets, that cash flow. What a great asset class that is. So let's go to number 2. Why is residential real estate a great income shelter? Well, we know that no matter who wins this next election, you have to know that with all the debt in the world, we're going to have higher taxes. So being very conscious of how your tax dollars are being spent and how you are being taxed is going to become paramount to you as an investor. Real estate is an incredibly tax advantaged real estate investment. Now, first off, let's talk about depreciation. So if you buy a house for $300,000, you are allowed to depreciate the structure. You can't depreciate the land, but you can depreciate the structure. And of course, the formula I like to use is that I believe that 85% of the purchase price is the structure. So right around $300,000, you have $45,000. 15% would be land. You can't depreciate that, but you can depreciate about $245,000 over 27 and a half years. That is going to give you an $8,000 deduction. So if you made $100,000, this deduction is going to reduce that revenue down to $92,000, and you're going to save that. Now, keep in mind that we have a strategy and a plan that we want you to acquire at least 10 properties in a bundle. Just think if you had 10 properties, each one giving you $8,000 a year in depreciation, you make $100,000, you have $80,000 reduced off your income on your taxable gain, on your taxable ordinary income. So instead of paying taxes on $100,000, you're paying taxes on $20,000. So not only are you getting a deduction that you're not paying on, you're also being dropped from tax rates. So instead of being at the high tax rate, we can get you down to the low tax rate. It's just absolutely wonderful. And of course, this is going to become extremely, extremely important in the coming years because we just need to be paying attention. We're also tax advantaged in this way. We don't have to pay, we don't have to do a capital gains. We can use a 1031 exchange. So if you're selling your property in Seattle, if you're selling your property in Portland, if you're selling your property in Minneapolis or Chicago or New York, and you want to get your investments out of there and come here to Arizona, you can use a 1031 exchange, use all of the proceeds to purchase the next one, use a 1031 exchange facilitator, and the capital gains event is not triggered. There is no capital capital gains event, and you save all that money. You can keep bringing that capital gains forward until forever. Now, keep in mind, here in Arizona, we talk about forever. We are a community property state, another terrific tax advantage for owning real estate here in Arizona. So, husband and wife can own a property as community property with right of survivorship. And if one of them dies, and look at as a baby boomer, that's something that happens. The surviving spouse gets all that capital gains, all that depreciation forgiven because they get a double stepped up basis on their assets in real estate if they hold it in community property with right of survivorship. How cool is that? What a great estate planning tool can that possibly be? So we can get deductions, we can get depreciation, we can take that off our taxes. We're a tax advantage state when it comes to moving our assets around, and we have estate planning tools. How cool is that? Number 3 is another easy one. What does the population expansion mean to the rental market? Oh my God, this is like a soft pitch right down the middle to me. We're here in Phoenix. You guys know exactly what happens when we have a population increase. It puts demand on housing, it puts demand on rentals, and of course, when there's demand, prices go up. And here we are in the United States. The entire United States is still the population expanding. We have more births than we have deaths. So we're not, maybe it's about 0.5% or 0.75%, but the population is growing. So we constantly need more housing because housing is what? It's a basic shelter. That's food, water, and shelter. You got to have a place to live, and it keeps growing. So again, more demand. But what about when we're in one of the great markets of the country, like Florida, Texas, or Arizona? Why, of course, you get organic growth. And here in Arizona, we are seeing organic growth like crazy. And it's driving not only the asset prices up, because you guys have all noticed in the last 6 or 7 months that prices of homes have just gone up like crazy. And we're told that about 11% so far this year through July. We haven't got August yet. So we've had across the board increases in appreciation in Maricopa County, 11%. And in some of the asset classes like we deal with, like the entry level, they're up 16% in 7 months. That, my friend, is called demand. And that's what happens when you get population. And this, we've talked about before, is an extremely long-term trend that may actually accelerate. So what a great reason to own real estate. So why does real estate have such strong capital returns? Another slow pitch for me. It's because we can leverage these properties. We can get 30-year mortgages. And I'm going to tell you, here in the United States, we have 30-year fixed rate mortgages that will fully amortize over 30 years. That house will pay off. This is unheard of outside the United States. They don't hear about this in Australia, New Zealand, Canada, Europe. They don't have this. Here in the United States, we have a mortgage that will pay off after 30 years, fixed rate. So you can fix this rate today, and that rate will stay the same for 30 years. Now, keep in mind, we're talking about leverage. And if you're a beginner and you want to start some of our strategies, say we get you, if you're a vet, you can buy these for nothing. If you have good credit, you can buy it with FHA with 3.5%. If you have marginal credit, FHA is going to try and put you into a house. You can raise your down payment to 10%, and they'll look at your credit, even if it's got a little problems to it. They'll try to do everything they can to put you into a property. About 85 to 90% of the population of the United States qualifies for an FHA loan because they really are there to put you in a property. So looking for 3.5 to 5%, you can get a brand new house. You can get yourself a home for yourself. And if you bought a $300,000 house and you put $15,000 down and it went up 11%, not the higher end. What if it went up just on the low end? That $300,000 house went up $33,000. So if you put 15 down in January and it's appreciated $33,000 this year, that's better than a 200% capital gain in 7 months. And this is going to continue on and on and on. We've got a multi-year trend. So why aren't you doing this? So let's go on to number 5, another slow pitch for me. How does leverage concept maximize return? We're using other people's money. That's opium. We can use this money for long term. That comes to you with no prepayment penalty. You can actually decide, I'm going to take a 30-year mortgage, pay it off in 10 if you want. It all depends on you, and it's someone else's money. So it keeps value retention. Here's the other secret to it. If we get into a stagnant market, you buy a property and we don't get this appreciation, which would be pretty hard to imagine that here in Arizona, we're not going to get appreciation. But let's just for the exercise say we're not going to get it. After 30 years, you put 20% down on a property. After 30 years, you have 100% back. You've earned 5 times your money. You buy a house for $100,000. You put 20 grand down as a real estate investor, and that tenant has paid that mortgage off, so you get $100,000 back. So built into your investment is a 5 times return over the life of that mortgage. You don't have to do anything but make the payment. And if you put a tenant in there, who makes that payment for you? Why, it's the greatest person in the world. Your tenant. They make their home there. You own the property, but they make the payment and they pay the mortgage off. It's built into the loan. How cool is that? So what's another slow ball for me? Why is cash on cash so important? Well, we want to check the cap rates. So we want to know the cap rate is going to tell you where you are, if this is a good deal or not a good deal. So every region in the country is going to have a regional cap rate. So once you do the calculations, you can find out where you are in that cap rate. So here in Maricopa County, we have been right around 4.5% for a rental. As the prices of homes go up, the price of rentals go up, and it seems to be fairly stable at about 4.5%. Well better than the Bengen rule, and it grows. So if you get a return that's maybe 4.75%, you know that you got a pretty good deal. If it's down in the 3s, you're going to say, well, I'm paying a lot of money for this property. But it tells you where you are, and of course, you can then make a decision, is this a property I want to buy? Because you can see what your returns are, and then you can make an educated decision as to whether I still want to continue moving forward on this property because it might have special considerations. Maybe it's next door to your sister. Maybe it's a piece of property that you've always wanted. Maybe it's located right up against the mountain, and I want that property. So, but you're going to know exactly where you are with this. Also, keep in mind, what else does cash on cash do? I'm a baby boomer. What lights my fire? You know, I take that money. We go on cruises for that cash flow that's being sent to me from the greatest people in the world. And it just keeps growing. So I want to get that cash flow. I want to be in a market where we have historical increases in rent, and it becomes spendable income. Like gold, we talk about gold. Gold can go up in value if you get inflation. If you get into some turmoil, people will go to gold. Can't spend gold. You can't take gold down to the grocery store and say, "Hey, look, here's 10 ounces of gold. I want to buy a bucket of noodles for myself." Can't do that. You can do that with the cash flow that you get very, very spendable off of your rentals. So I want to go over this. I want to go over this pretty quick with you. I'm trying to be very considerate of your time. This is going to be a case study of a property. Now, I want you to pay very, very close attention to this. I want you to understand this is what happens in your portfolio. If you have a property, you can expect this to happen. We are long-term investors. We're looking to hold these properties at least 4 or 5 years. But if they're appreciating and if they're paying cash flow, why do you want to sell them? You want to build wealth. This is not what that's the difference between when you flip and when you hold. So a flip gives you a nice income. This is going to build long-term incredible wealth. So let me just go over this with you. So here's a property that was purchased here in Arizona in 1984. So you have to remember in 1984 prices were considerably different, $44,600. The down payment was $9,200. Now every time I'm in a seminar, people say, "Oh, well, you have to remember, it was only $44,600. It would be easy to buy a $44,600 house. Some of you guys get commissions that are almost that." But keep in mind, in 1984, the average sale was only $45,000 or $50,000 or $60,000, and commissions was considerably lower. In 1984, it took between 5 and 6 sales to come up with the 20% down for a purchase. And today, guys, I'm going to tell you it's the same thing. If you can sell 5 or 6 properties, you can generate enough income for yourself to buy an investment property. Because as prices have gone up, commissions have gone up right along with it. And of course, it stayed stable. It's the same set of parameters in 1984 as we have now. So keep that in mind. So the down payment was $9,200. This property was bought new from a builder, if you can imagine that. A brand new home for $44,600. So gravel and mini blinds were incredibly upgraded. So the total cash of $10,600 was put into that property. And I want to make sure you understand, when we buy these properties and put our down payment, we factor in what the down payment is, the closing cost, and whatever the standardization fee would be or repair value. And that is the last cash we put into the property. The property at that point should become a standalone investment. And because we're going to escrow for repairs, we're going to escrow for our management company. We're going to make sure that that's included in our net figures. We're going to take in the fact that we're going to have costs of leasing. We're going to have a vacancy factor in there, plus taxes, insurance, and homeowners fee, all included in that, and still get a cash flow. But we're escrowing for any future repairs so that you don't have to make any more down payments. That's the last time you have to put cash into it. So this property, the total acquisition cost $46,000. Now, last month, August of 2020, that house had grown from $44,600, total of $46,000 acquisition cost, to $275,000 today. $46,000 to $275,000. But wait, you only put $10,600. So honestly, that went $10,600 went to $275,000. How about that for an investment? And that is in operation today. Now, keep in mind that not only is it still appreciating, it's still cash flowing. That property still gives $1,000 a month spendable income each and every month. That's $12,000 net. That's after everybody gets paid. That property still gives $12,000 a year, every year, and it's growing. Next year it'll be $13,000 or $14,000, pretty doggone easily. So not only did we get appreciation and we had a loan get paid off, that property got paid off in 2002. The property was also, we get depreciation. Now keep in mind, the same formula was $46,400 times 85%. You had a base of $37,900. And of course, you got $10,600 in tax savings. We also, over the life of that loan, over the life of owning that property, we have extracted $215,000 of income on that property. $215,000 for a total return. Are you sitting down for this? That $10,600 investment has had a total return of over $500,000. That $10,600 went to $512,000. Now, I know some of you have bought Amazon, but most of you have not. And how are you going to get an investment like this? It's right here in Maricopa County. If you have a gap in your investment scenario, if you have a gap in your retirement and you need more money, if you're 50 or 60 years old, this works absolutely perfectly for you. Let me tell you that if you're 70 years old, I have people say, well, I'm 70 years old. I don't want to start thinking 25 years down the line that I'm going to have this property. But, you know, the odds of you living to 95 or 100 are absolutely terrific. And you have to be careful not to outlive your nest egg. This will never outlive its nest egg. It will grow. So put yourself that building bought in 1984 could be bought in 2020, and you're going to have the same type of parameters happen to that property. So when you're 95, your wealth has gone up 5, 10, 15, 20 times or more. It doesn't deplete. It's one of the greatest retirement vehicles you can possibly have. It's absolutely terrific. If you're not putting into your portfolio, you have to ask, why am I not doing this? So that's done for my rant. I want to talk to you about this. If you're not putting into your portfolio, you really need to think about this. If you're not putting into your personal portfolio, you need to call me and talk to me. I'll talk to you personally. Keep in mind that I offer a consultation free. You're welcome to come in. We'll give you an hour. It's really all you ever need is come in and see me. And if you're not doing this, come talk to me. We'll talk about why we're not doing this. And you should be talking to your clients as well. They are the same as you are. They have gaps in their portfolio. They have gaps in their retirement. And this will fill that gap. So keep in mind, Friday we have Joe Needham coming in. We're going to talk about how great real estate investing has been. And next week we're going to talk about strategic real estate, how using real estate can help you achieve your long-term financial goals. And that's going to be an absolutely great one. We got some strategies that you can employ. So let me just go through this. Real estate is tax advantage. It gives you a terrific depreciation. It gives you terrific advantages for estate planning. It gives you terrific advantages if you want to move from Illinois to Arizona, to the great state of Arizona, where you can get your properties growing for yourself. You can do that without having a taxable event through a 1031 exchange. We got a cash flows. We have a property that is going to be a great inflation hedge. And these are just wonderful things. Now, if you have any kind of questions or comments, if you like the format that we're using, I would love to hear that. You're welcome to email us at creatingwealth@westusa. You're welcome to use this residential rental format. This is a flyer that you're welcome to get. If you just email again at creatingwealth@westusa, and we'll get that sent out to you. If you'd like to register for our upcoming seminars or upcoming classes, send it to creatingwealth@westusa. And you're always welcome to call 602-942-4200, and let's set an appointment for you to come in. We'll talk one-on-one. You can bring your spouse, you can bring your financial advisor, and we're more than happy to talk about this because I want you to actualize your life. This is my give back to you. I want you to have everything that your life is meant for you to have, and it's always my very best to you. Bye-bye now.